Hello, hello. Welcome to another episode of Homebuying Secrets. Today, we're going to cover the dark arts of mortgages. Before we get into that, lots of things happening in the broader market. Why don't we start off with you, Jason? What's going on with interest rates?
Yeah, great question. And wish I could tell you exactly what was going on with them. Obviously it's the market. Nobody really knows what's going to happen. But basically, what has been happening is they've been going up. A couple weeks ago, the Fed basically announced that they're going to begin to taper their asset buying purchase program. In essence, what's happening that's keeping interest rates really low, or that has had them really low, is that the Fed has been buying mortgage-backed securities, and so they've been a massive buyer. They're buying them, left and right. So with the amount that they're buying, it helps reduce interest rates. Now they're getting to a point where they're saying, hey, the relief is happening, things are getting better, so we don't need to continue to buy as many of these mortgage-backed securities as we have been. So they're going to start tapering back their purchases, and that kind of sent the market into a little bit of a tailspin. It hasn't been an insane sell-off, like one day overnight thing. But basically every single day that I come into the office, I've been seeing interest rates get worse and worse and worse for the past, about 2 weeks. Looking at the market right now, it does look like it's coming. Today, it's down a little bit. But yeah, I mean, the trend right now is up, up, up. There's a lot of people in the industry that have been kind of freaking out over the past couple of weeks. And, definitely a lot of uncertainty. Are these super low rates that we've been holding on to for a while, is it now finally over? Who knows? We'll see. Right now the trend is up.
So I know that I believe the historical interest rates average for the United States is something around 4.9%. So in the grand scheme of things are still low, which is why I've been just telling all my friends, like, hey, if you're even thinking about buying a house right now, yes, maybe you missed the valley, right? It was like 2 point something percent. Like, you need to just get in on it before it gets to even higher than this. So Frank, question for you: with the recent spike in interest rates, has that affected any of your clients who are maybe in the middle of looking for a house, or people who are close to finalizing like a deal, and they like are just trying to they're just rushing to get a loan signed?
No, no. I mean, just like you said, Valley maybe like 2.7, 2.8. I mean, what's the rate now, Chasing? Like 3.1. So it has gone up. Larger loans, yeah, it's probably a couple $100, but it hasn't really pushed the needle as far as someone's like, oh shit, I'm in escrow. I was gonna buy something, now I'm not, or I was pushed to my max and now I can't buy in this neighborhood. Not yet. It will get there. The last two properties that I've listed, one was last week, one was the following week. Both went into escrow within the first week. One I listed at 1.25, got it in escrow at 1.3, had 6 offers, several over asking. Second property in Santa Ana listed for 885 and got 920 for it. So they're all just going into escrow just as fast. Even coming into this holiday season, buyers are out there. They know.
That's awesome. I think that's probably because we've had like a glut of just qualified buyers waiting to get in, and
there's just
so
not
that's
enough.
good.
There's just not enough houses out there.
One more question, which kind of leads into our mortgage topic, is so Jason, what naturally should happen between what is a relationship between interest rates and prices?
I mean, theoretically, as rates rise, prices should soften. I wouldn't say that they're going to, turn around. It's not like, something that's $1 million and rates go up a percent, it's going to now drop down to 750 or anything like that. But, theoretically, it should slow down the appreciation, because you just have less qualified borrowers, right? So if 100 people qualify when rates are, where they're at right now, if they go up a little bit, as they go higher and higher, you should see the amount of people that can qualify for a certain amount of money basically lower and lower. So from that standpoint, yeah, you should see things slow down a little bit. And I think more so along the lines of expectations. If I'm somebody looking for a house, and say my price point is $1 million, and I'm looking, I see things that I like, I'm trying to get houses under contract. Like Frank said, there's a lot of offers coming in, so I've got to bid higher. I got to be pretty aggressive. And now 3 months, 6 months later, instead of qualifying for that $1 million, well, now I only qualify for $950,000 because the rates have kind of ticked up a little bit. So now, not only was I having a hard time finding something in the price range that I wanted, now I'm still paying the exact same amount and I'm getting less than I wanted to get. So from that perspective, I think, that's where you're really going to see, especially in the short term, is you'll see people get kind of frustrated. But I mean, yeah, right now, based on this market, and Frank probably has a lot more data than I do here, but I think there's just such a shortage of actual inventory that, rates can still go up a little bit, and it's not going to be the end of the world or really change things in terms of the housing market. But one thing I will say too about interest rates, John, you hit the nail on the head. Even though rates are going up right now and everybody in my industry is freaking out like, oh my gosh, the sky is falling. Interest rates today, maybe, in the low 3% range. I'm still getting people 2.99s. So they've gone up a tiny bit. But, historically, compared to where they have been, I mean, before the pandemic, we were doing loans at like 3.875%. And it was the craziest thing I'd ever seen, super low interest rates. Never thought we'd see these things. So we're still substantially lower than that. And where we've been historically for, the last 30 years or so, very easily, very, very low compared to those times. So it's really, in the scheme of things, rates are great. But again, it's a different economy. Everybody's used to low rates now. And once people get used to something, it's kind of hard to, move them away from it.
Yeah, it's so fascinating to be thinking about even buying a home right now, because when you look at what's happening with home buying, the pullback from tech stocks, because inflation or increase or expected inflation expected increase in interest rates hurts tech stocks. Then we've got crypto, which theoretically a lot of people think crypto is a hedge for inflation. And then this weekend, I think it was this weekend, you got Jack Dorsey, the CEO of Twitter, making a tweet saying hyperinflation is coming. You better be prepared. And then when he says that, I think he's basically trying to promote, crypto. So that might be, that might be hyperbole, but very interesting to see all this happening over the last couple of months. Okay, so let's dive into mortgages. There are just so many types of mortgages, Jason. Like, how would you define it? Like, what major categories, types, slices of mortgages are there?
Yeah, I mean, that's a good question. A lot of people will tell you a lot of different things. I think when I think of mortgages, there's basically kind of like three separate boxes. You've got your conforming conventional stuff, which is what most people are doing, which is what most people get when people talk about mortgages and you see advertisements. This is kind of what you're looking at. These are your Fannie Mae, Freddie Mac loans. They fit in that box. The rates are good. The down payments or options are really low. It's kind of your standard, gold standard, I would say, of mortgage that people get into. So you got that. You've got your non-conforming stuff that does not fit into that box, like jumbo loans, non-QM loans, so stuff with different types of income qualifications. So I'd say that's your second box. And then your third is really like the government loans. So VA, FHA, USDA. Those would kind of be the three main categories that I would consider when I'm talking about this stuff.
Got it. What's a non-QM loan?
Non-QM basically stands for non-qualified mortgage. So in 2008, we had this big financial disaster, right? And as a result of that, there was a lot of legislation that was done in our industry. The main one is called Dodd-Frank. So Dodd-Frank established a rule that basically said people needed to qualify for their mortgages. The reason for that is the main causes behind the collapse in 2008 was people getting into mortgages that they couldn't afford. And directly speaking about what we called stated income mortgages. So a stated income mortgage is basically a loan where, John, you could take out a loan and you're not going to provide any documentation about how much you actually make. You're just going to state to me how much you make. So you're going to state, hey, Jason, I make $150,000 a year. I'll say, all right, that sounds good. You're going to sign something, your loan documents have, in them, basically, you're stating this is true and accurate, right, John? And you're like, yeah, this is true and accurate. I make this amount. Okay, great. That's good enough. We don't need to see anything else. So because of that, obviously people are overstating what they make, to get into the home that they like. Especially back then, people's thoughts were, hey, I'm going to have, $50,000, $100,000 of equity just living in this place for 6 months. So, at that point, I refinance the thing again. I pay off any bills that I have. I pull some extra cash out. And it's just this cycle that they think is never going to end. Obviously, it did end and things changed. So because of that, one of the new rules, we have to make sure that you have income to qualify. It's called your ability to repay. We have to document your ability to repay. So Fannie Mae and Freddie Mac loans are going to document that through traditional means, right? Pay stubs, tax returns, those types of things. Non-QM loans don't fall within those guidelines. So they're going to show your ability to repay based on other means. So For instance, the big one that we see there is going to be for people that are self-employed, right? So self-employed people, they're going to write off a lot of stuff on their taxes. So maybe their taxes don't reflect how much income they actually make. So they're not able to qualify for, all these fully documented types of loans. So non-QM loans will give them non-traditional or different types of options. So for instance, bank statements, we'll take a look at your bank statements, add up all of the deposits that you have, and we'll assume that basically, hey, those deposits are income coming in, and we'll get an average of what your income looks like over a 12-month, 24-month history. We'll use that in terms of income, and that is your ability to repay. So the difference there is you're going to take on, there's higher interest rates for those types of loans. They also have some different types of terms there. Things like interest only loans are going to fall under that umbrella. Fannie Mae, Freddie Mac's not going to do interest only loans. So they're going to be loans that are kind of outside your normal realm of what Fannie Mae, Freddie Mac, and basically the government thinks of as like a safe mortgage.
Got it. So for example, if you are a software engineer at Microsoft, you're probably in your first bucket, conforming conventional standard loan. If you are, whatever your occupation is, let's say you generated a lot of your recent net worth in crypto, and you're, maybe you don't have a traditional W-2 job. Maybe you're in the second bucket, like non-conforming plus maybe jumbo loans. And I guess maybe, there's so many different categories. Maybe we could strike out one category for major discussion, and that is the government, generally the government loans. What type of people typically go for government loans?
Yeah, so your government loans they're going to be for a couple different types of people. So your three main government loans, you got USDA loans, FHA loans, and VA loans. So USDA loans are going to be for more rural properties. If you're buying a rural property, it may be something that works for you because it's going to have limited down payment options. You can put, I believe, with USDA. I haven't done any USDA loans. I'm in California. We don't mess with the rural stuff so much. But I believe you can put no money down, so you can have 100% financing on those. So they are an option for some folks. FHA is kind of the main bucket that we see a lot of people use, with VA as well, though. But FHA basically is going to be for lower credit scores, people that need to put lower down payments. It's for people with just kind of credit history problems, things like that. So credit challenged, I guess, is the word. They're going to just have a wider net that you can fit into when qualifying. And then kind of the third government bucket is VA. VA, I wouldn't completely rule out, because if you are a veteran, VA loans can be an absolutely wonderful option. With VA, kind of the big caveat there is a funding fee. So basically a fee that you pay to the VA in order to use the VA loan. If you have to pay that fee, that may or may not make that loan worth doing, but there are ways to get around it. For instance, any veteran who has a service-connected disability rating through the VA can actually get that VA funding fee waived. And if that's the case, the VA is a really, really, really good option. The interest rates are typically going to be lower than conventional loans, conforming loans. The down payment options are, you don't have to put a down payment down at all. So it just kind of gives people a lot more flexibility. Debt to income ratios are also, they have a much wider net with the VA. So, not necessarily loans that people use all the time, but they definitely have their uses. So I wouldn't rule them out completely, but for our audience, yeah, probably the VA loans for the veterans going to be good options, but not so much of the other two.
Good point. I'll share my story about my VA loan, which is apparently recently, in recent years, they removed the cap on VA loans, I think for first-time home buyers, or maybe for any home, but let's say it's only for first-time home buyers. So you can even put, $1 million, but there's also the conforming limit, which I think is designated by county. So if I go above the conforming limit, it becomes a jumbo loan, so they pay higher interest rates. So there's like an artificial, not a cap, but you're going to pay higher rates because of that. But before we get into that, I want to talk to Frank a bit. Is, let's say, you sell houses too sometimes, and let's say you get a couple offers in. What goes through your mind if you get like a conventional loan offer or like FHA loan? Do you see that level of detail when you're getting offers?
Oh yeah, for sure. I mean, when you get the offer, the RPA sent over to you, it breaks everything down, what kind of loan they're getting, down payment terms. The biggest thing between conventional and say like an FHA is going to be the down payment, and just like how solid the buyer is. Usually FHA is like down payment assistant, like low down payment. They work with people that have less than perfect credit. So, I mean, yeah, it's pretty easy to see the difference because, FHA, they're going to be putting 3.5% down, probably only have maybe another $3,000 or $4,000, if any, in the bank. Whereas you have somebody that's conventional, not everybody's putting 20% down, but say they put 10 or 15, they have another $50,000 or $60,000 in the bank. It's not completely tapping them out. So that's, you see it right away in the offers.
So give us another refresher. You mentioned this the last couple episodes. So once again, why does the seller care? Is it because things might happen during when the property is in like escrow process, and then people with less financial stability, they might drop through, so you're wasting time?
Yeah.
Like because otherwise, besides that part, why would the seller care? Because it's once someone gets a mortgage, they get paid off, right?
Yeah, because of your escrow period while you're getting that loan going through the process. The conventional person that has more money down, has more money in the bank, has a better FICO score is gonna, the chances are they're gonna close that loan. Whereas the FHA person, is not as financially strong. So when you have your house on the market and then you accept an offer, the real estate agent goes into escrow on the multiple listing service, the MLS. You code the property as in escrow now, so it's off the market. So you're not getting exposure. So you don't want to pull the house off the market and have your buyer fall through, and then you got to put it back on the market, because that 2 or 3 weeks while you were off the market, I mean, a well-qualified buyer could have come by and purchased it, and it was in escrow, and they just move on to the next one. So as the agent for the seller, you want to make sure your buyer is qualified and they're the ones that are going to close. I mean, price, most of the time sellers want the highest price, but I mean, it's got to close or else I mean, the price is nothing.
Okay, so once again, I like your framework, Jason, with the 3 buckets. So now that we've, let's say, buckets are the columns of a spreadsheet, and now I want to talk about like the rows, right? So we kind of cover types of borrowers. What about types of interest rates? Or I don't know what the right word to put this is, but there's like, or type of payments, right? There's like 30-year fixed payments type mortgages. And I've been hearing a lot about ARMs. Tell us more about ARMs versus conventional or fixed.
Yeah, so ARM stands for adjustable rate mortgage. So it's, a loan that is, variable, it's adjustable, it's going to move around compared to your fixed rate. So fixed rate is going to be the same rate for the full period, right? Whatever that is, 15 years, 10 years, 30 years. Adjustable loans are going to have rates that adjust. So typically you're going to see them fixed for a set amount of time. Usually it's 3, 5, 7, or 10 years. And then after that, they'll start adjusting every 6 months, every year. Right now, the majority of them are adjusting every 6 months, and they're all going to have different caps. So every adjustment cycle, it can only adjust so much. Over the life of the loan, it can only adjust so much. And that's going to, vary depending on, the loan that you select. But yeah, what they're going to do is they're going to give you a lower introductory rate for whatever that fixed amount of time is, and then after that, they're going to start moving. So they're not as widely used loans. Most people just defer to a standard fixed rate loan. But they can definitely be super valuable in the right scenario, right? Like if you're going to be selling a property in 5 years, 3 years, whatever the case is, then yeah, you might as well take out a lower interest rate for that time, especially if you're not going to be there. The one kind of caveat there is a lot of people just don't know what's going to happen. So they're going to default to a fixed rate that they never have to worry about. But yeah, if you really have an idea of what's going on, they can be good options. In jumbo loans, we see them used a lot more often, and especially for people, I'll get clients that are just maybe slightly above the Fannie Mae kind of conforming loan limits, and they know that they're going to pay that loan down to a certain amount. Sometimes those types of folks will go for an adjustable loan because they know they're going to refinance into like a Fannie Mae loan in the next few years. So yeah, you see them for those uses. I mean, right now though, the challenge is interest rates are so low that a lot of people just say, hey, I never want to deal with this again, I'll go with a fixed rate. But yeah, adjustables are very valuable for the right person in the right scenario.
What are some common scenarios in which ARMs could be useful? Is it maybe perhaps we are in a medium to high interest rate environment, and then you're predicting that the interest rates will go lower. So maybe at that time, not only are you getting a better introductory rate, but if you suspect for, let's say we're in an opposite example where the Federal Reserve is not tapering, but ramping up, buying of mortgage-backed securities. Is that a common scenario?
I mean, not really. I don't see people kind of playing the market in that way. But theoretically, yes, that would be a time that you might want to jump into something like that. But we don't really ever, that's not something I've personally seen too much. I really don't see many people using them at all. I mean, gosh, I would say in the total, it's kind of percentage wise of my business, maybe 1%, maybe less than 1% are doing adjustable mortgages. I think one of the things is just the stigma that's attached to them is probably one of the factors that are weighing in. So one of the main causes, in addition to stated income loans, for the 2008 financial collapse, it was also adjustable rate mortgages. So a lot of people were taking out loans that are fixed for 2 years, 3 years, 5 years. On top of that, they were layering on the fact that they'll get an interest only payment for that first fixed period. So in that scenario, let's say your loan is, fixed for 3 years with an interest only payment at this, really low interest rate. Well, now all of a sudden, when that fixed period, if that fixed payment period goes away, now your interest rate can adjust. But the big thing is, it's going to lose the interest only option. So now instead of paying just interest, you're paying principal and interest. And since there's not 30 years left in the loan, your payment is, going to be amortized over a shorter duration. So, now instead of 30 years to pay back the money, you're paying it back in, 27 years, 25 years. If it was a 10-year fixed period, now it turned basically you're looking at a 20-year mortgage. So you can see payments jump up pretty dramatically in those scenarios. And so because of that, a lot of people were running into issues. And that was also, a main driver of the 2008 financial collapse. So there are a lot of people that I talk to that, just because of the stigma based on that, those past experiences, I don't want anything to do with an adjustable. I'm a fixed rate only person, even though for a lot of these people, an adjustable may actually be the better product, especially if it's, I'll talk to people that are moving in a few years. Hey, we're absolutely selling this house. My kids are graduating from high school in 3 years. And at that point, we're going to downsize. They're going to move to college. So for somebody like that, it's a great product, but I still see some of those folks just, completely living in fear based on what we saw before. So they'll just default to a fixed rate just for the safety of it.
Okay, you just mentioned something else, and let me know if this is even a type of mortgage. Are there mortgages that are only interest only mortgages for a fixed number of years? Why do those exist, and what's the point of those compared to everything you just mentioned so far?
Yeah, so there are absolutely interest only loans. Like I said, I mean, that was one of the main problems that we ran into back in 2008 is they were a lot more prevalent than they are today. And I mean, the pros of them are basically you have a lower payment that that you can make. So it gives you more flexibility in your payments. We don't see them a lot in the kind of lower loan amounts. So like just the standard loan amounts that people are getting these days. So right now, interest onlys are a lot more prevalent in jumbo size loans. Jumbo size loans, you're typically dealing with a more savvy borrower who is they just got a better grip on their finances, right? You've got to understand what you're doing because you can put yourself into a negative, situation. So, not nearly as used now as they were back in, those years, 2008 and before, but still an option. And it could be a good option for some people, self-employed folks whose income is going to vary. Maybe you'll have, months of, a ton of income and then a few months where you don't have much. Could be a good scenario there. They're also, you're in more control of your mortgage with an interest only loan. You just have to kind of know what you're doing with it.
Got it. Okay, let's talk about jumbo loans then. What is a jumbo loan and who defines the loan limit of a jumbo loan?
Yeah, so a jumbo loan is going to be a loan that is higher than the county loan limit, that Fannie Mae and Freddie Mac will go ahead and accept. The entity that sets those limits, it's going to be FHFA, the Federal Housing Finance Authority, which was a government agency created in the wake of 2008. So it's not Fannie Mae directly, it's FHFA that sets those limits. And the way that they do it is basically there's one base limit for the entire country. So right now it's $548,250. Speculation is next year it's going to be $625,000. So that's going to be kind of your base for the entire country. And then in certain what they call high cost areas, you're going to be able to go above that limit. And then it's going to change depending on how high cost it is. So right now, the highest high cost areas that there are, it's $822,375. The speculation is that next year that's going to jump up to $935,000. And again, there's going to be, all sorts of different limits, anywhere in between there. So for instance, for, people in California, Los Angeles and Orange County, Right now, we have the 822,375 limit. Areas like, San Diego County, Ventura County, they're going to be higher than the lower $548,000 limit, but they'll be somewhere in between. So you'll see counties like that all over the country where, maybe they're not the full amount, they'll be somewhere in between, but those limits are all set by FHFA.
Got it. So let's say, we're probably not talking to, like, the people listening to us are not people with probably all cash offers, because they could just, they go make an all cash purchase. So I'm thinking about the people who have the financial means for the big down payments. But regardless, then I guess the thing they need to think about is how much do they want to borrow? Because they could borrow up to Los Angeles and Orange County 822,375. So then it's a matter of how much comfort they have in, hitting that number or not. What happens when you go above 822,375, let's say in Orange County? It becomes a jumbo loan, right? And does jumbo loan have like higher interest rates, or what other hurdles are there?
Yeah, so jumbo loans, one of the main things about jumbo loans is there's no real set rules for them, because kind of the main difference here is the Fannie Mae stuff that we've been talking about. It all has to fit a certain box, right? It fits a certain box, and then Fannie Mae, because of that, will guarantee kind of liquidity on the secondary market. So lenders will be able to make loans, Fannie Mae will purchase them, and they'll be able to then make more loans and repeat the process. So if you're a lender that's making Fannie Mae loans, you don't plan on holding on to those loans for, it's a 30-year loan. You don't plan on holding on to it for 30 years. So you're going to have more liquidity to make more loans. Jumbo loans, those loans are what we call portfolio loans. So for the most part, they're not going to get sold like a typical Fannie Mae loan will. So because of that, whatever bank is giving you that loan, they set all of the rules, because they're going to be holding on to that loan for, however long you have it. Interest rate wise, for the most part, you're going to see the interest rates are going to be higher on jumbo loans. It's kind of the rule of thumb, but I've also seen some where they're a lot lower. Those are typically cases where you're going to have somebody that's got a lot of money. And so the bank is willing to take a little bit of a loss on that interest rate, right? Just to get your business in. So like we've got a jumbo product that we do where, if you bring in $1 million and set up an account with, the bank that we do it with, you set up a checking account, a brokerage account, savings, whatever. You bring $1 million in, they're going to give you 0.5% off the interest rate. So if the interest rate starts at 3%, boom, you're down to 2.5% just because of that relationship. And that's because they want to make money, offering you other products and servicing your accounts, things like that. So you'll see interest rates on jumbo loans all over the place. That's going to be one thing there. The other kind of difference is usually debt to income ratios are going to be not a lot lower, but lower. They're typically 43 to 45%, as opposed to Fannie Mae loans, which go up to 50%. You're going to see a difference there. Credit scores are also going to be a difference. So with your typical Fannie Mae, Freddie Mac stuff, 740 is usually the number that you need for top tier credit. Some lenders will have 760, but it's usually somewhere between 740 and 760. On a jumbo loan, that's going to go all the way up to 800. So if you got a 740 credit score, where that best, cream of the crop Fannie Mae, that's not that great of a credit score in jumbo. So you can go all the way 800. 800 credit score is going to have better pricing. So you have maybe lower interest rates, lower costs. But I'd say those are kind of the main differences with jumbo loans compared to the Fannie Mae, Freddie Mac stuff.
Yeah, it's so interesting I love this story about the, depositing $1 million to get like a lower rate, because, first of all, if you have money, I feel like you can make money, or you can save a lot more money. There's one way in that. Another story we had on a different episode of a different podcast I had was, I was talking to this like private wealth manager, and he was saying, they don't have like a strict limit, because it's based on what they think you as an individual can produce. But let's say it's like $3 million. But let's say you open up a $3 million account with them. They will let you put kind of whatever you want into your IRA account, such as like art. I had no idea you could put like art into an IRA account, but you could do that. You can put all sorts of stuff in there, and then it basically appreciates. Not tax-free, but at the tax rate of when you retire, which if you're making that much money, you're really no longer like a salaried employee, right? You're just really generating like wealth and investment income. So it's just fascinating the stuff you learn like throughout this whole process. So question for you, Frank, besides the type of loan and the purchase price or the offer that the borrower is submitting, do you even see, or even care about all the other details that we just talked about? Like, oh, this person has like a adjustable rate mortgage. None of that matters to you, right? You just care about type of mortgage, like down payment, and financial stability of the buyer?
Yeah. So one of the things in addition to so there's three things when you submit an offer. Generally, it's your proof of funds for your down payment, your actual written contract, and then your loan approval letter. When I start getting offers, sent into me, so if I get like 10 offers, I'm not going to call every single loan officer. But when I narrow it down to like, say, like the top three, then I'll look at the loan approval letter and I'll call the loan officer up and just kind of just talk to them. See, I just throw some questions out there, pick their brain, see how responsive they are, if they know what they're talking about. Items like that. But usually stuff will flush out like, oh, if it's an adjustable rate mortgage or what's the plan on that. But yeah, start getting the details. And I don't really necessarily care like what their exact interest rate is. My main thing is like, that they perform and that the loan funds at the end of this 21 or 30-day period. That's what my whole goal is. Transactions, get the best qualified buyer in there and have the transaction close.
Jason, did you have something to say?
Yeah. So, I mean, along those kind of lines, the big difference that we see on the lending side is, I know that there are companies out there that are providing pre-approvals that, their loan officers are not, nearly as skilled as some other loan officers, right? I mean, it's just, you understand when you work in this industry, there's certain companies that hire people that are pretty much brand new to the industry. And then there's other companies that are going to have more seasoned people. When it comes to more complicated and difficult income scenarios, right? Your W-2 borrowers, salaried employees, really simple to calculate, right? What's your salary divided by 12? That's what we're able to use every single month. But when you get into more complicated scenarios, self-employed clients, people with investment properties, just more complex financial scenarios and situations, you run into the chance that, hey, is that pre-approval letter actually valid, right? So like Frank said, he's going to kind of call people. He's going to test the waters a little bit, throw some questions out and see how they react, right? Because when you get a loan approval from those particular companies or one of those companies that, may not have a reputation of having, the most outstanding type of vetting process, well, that's where things can kind of fall out of escrow. So, I would say that's kind of what Frank is looking at there. The other thing that I look at is, on a jumbo loan, for instance, so if I'm talking to a client and they want to put an offer in, and let's say they are right over the jumbo loan amount, they would prefer, or the conforming limit, they would prefer to have a jumbo loan so they don't have to put as much money down. One of the things we'll talk about is, hey, how aggressive is your offer going to get? Are you going to do a standard 30-day escrow with a 14-day loan contingency or a 21-day loan contingency? Or are you going to try to rush this thing through? Do I have to have your loan contingency removed in 7 days and you're funding this thing in 21 days, right? Because in that scenario, there's certain jumbo lenders that I just know are not going to be able to hit that. So the difference in kind of where we go and what program we use is going to kind of change based on, what that offer looks like.
Cool. Thanks, guys. This is a very informative session as always, and we'll catch you all next time. Thanks.